doing DeFi, greatest in the world, and they finally about to see why. What you know about XRD? I'm smart money, I ain't never on a decline. What you know about NFTs? It's not just Ace, when you finally gonna realize you need scalability, need more utility, then you better call on these guys. I'm going radical, I'm going Radix, I'm going radical, I'm going Radix. Hyperspeed DeFi, never on a decline, building the future, I feel like a savage.
Hello and welcome. I am Piers, CEO of RDX Works, a core developer of the decentralized finance protocol Radix, a public ledger entirely focused on bringing DeFi into the mainstream. This is our podcast, the DeFi Download, a show about decentralized finance and all things crypto, where we dive into the details of the projects, assets, and services that are powering the DeFi revolution. Today, I have Noah Litvin. Noah is a core contributor to Synthetix. Synthetix is trying to solve the problem of how to trade derivatives in a crypto-native way, not just spot. So think about it like Uniswap, but for derivatives. Synthetix started in 2018 and is one of the OG crypto projects that I certainly remember when DeFi was just in its infancy. And I think it really trailblazed a bunch of the important functionality that you see in crypto today and was really, really forward in thinking in what was possible on public ledgers back then. So it's fantastic to have you on the show, Noah. Welcome.
Thanks for having me.
So you've been involved in Synthetix. You started out as a contributor, a community member, and you've been involved in Synthetix for a decent period of time now, right?
Yeah, it's been about 2.5 years at this point. Yep.
And what attracted you to Synthetix originally?
So previously I was working on a more TradFi fintech startup, and I was sort of surveying the landscape of sort of what was happening in DeFi at the time. And really, the entry point was really more around, for me, around oracles, where it's like there are all of these interesting mechanisms that we can build with smart contracts, all of these primitives, but you still need some system. The oracle problem itself is super interesting, but at the end of the day, it's like, how are we actually getting things off chain, on chain, other than externally owned, other than just people submitting transactions on their own behalf for their own wallets,
right?
And 99% of the Oracle services right now are providing price feeds.
Right.
So I'd love to see that expand further, but that's the clear use case right now.
Right.
And yeah, Synthetix is one of the biggest names in the space working on that problem, and like how to exploring what we can do with those integrations. So yeah, that's sort of what drew me in.
I'm sure we'll dive into it. But let's start just with like a basic orientation on Synthetix. So we're talking about how to solve the trading of derivatives on public ledger, and I suppose the big goal here is to compete with exchanges, with centralized exchanges. So could you talk a little bit more about, just take us through the history of Synthetix and how the product has evolved over time, and what Synthetix V3 really means for that ability to start potentially competing with the likes of Coinbase and Bytebit and all these kind of big exchanges for the user base of crypto.
Yeah, absolutely. So Synthetix started under a different name as Haven, and it was more of a stable coin and payment processing project. And over time, the focus shifted over more to spot synthetic assets. So SBTC, for instance, and from there, the interest is sort of shifted more towards perpetual futures. Active traders prefer perpetual futures markets to spot assets. So there are different pros and cons.
Yeah.
But overall, I would say, like at a super high level, the trajectory of the project has shifted from focusing on stable coins to spot assets, right, to perpetual futures.
And when you say spot assets, I think what many probably don't realize is you have the Synthetix protocol, at least with V2 it might have been V1, when you had this ability to create these derivative instruments. These derivative instruments were actually resulted in tokens, as you say, like SBTC was the Synthetix Bitcoin representation on Ethereum, and I could go and buy a Synthetix Bitcoin representation, and I could go and send it to someone else. It was like this continuous asset that should always be worth one Bitcoin, and then the way that you allowed that to occur is you kind of had this exchange built into the Synthetix protocol where you could turn collateral into a representative asset and then trade those representative assets between each other within the Synthetix exchange. But you could also take that out and then go and trade that on other exchanges and send it around to people. What was the thing that held that back? Because it feels like, from a simple point of view, that would be an easy thing to then create an Apple share with, or a Tesla share with, or to, like all of these things that people presumably want to be able to hold and trade within crypto, and being able to do it in a tokenized way where I don't have an open position on a perps market. I've just got this thing and it's worth the same as the reference asset. Why was that problematic for in how it was achieved?
Yeah, it's a really good question. So, like, backing up a couple of steps, the Synthetix stablecoin is issued as a collateralized debt position. So it's similar to like the early implementation of DAI and MakerDAO, and it's similar to Liquidity in that way, where you deposit some collateral and then you're able to effectively take out an over-collateralized loan of stablecoins against that collateral. And so right off the bat, the scalability becomes limited, right? Because like right off the bat, there's this haircut of like, we need to have enough buffer of the value of the collateral for the amount of debt being issued by the protocol. And then we add the ability to exchange that, let's say SUSD into SBTC or something like that, right? And now, so right now, so in that sense, like now the issuance ratio is still this buffer of sort of how much we're able to safely issue and make sure we have enough collateral for. Another challenge is the price of Bitcoin fluctuates, obviously. And so the amount of debt that the system is carrying is sort of at the mercy of the price fluctuations of whatever traders have moved into, right? So we end up in this situation where the liquidity providers are taking a position on these assets sort of based on the market fluctuations and the activity of traders in the system. The big innovation with perps is that you can take a long or a short position on the market. Right. So liquidity providers aren't necessarily taking a short position on Bitcoin if someone is holding SBTC. They're really sort of taking the difference of the long and the short positions. And we have this funding rate mechanism and a premium discount function that essentially incentivizes people to even out the market, or it incentivizes arbitrageurs to even out the market. So liquidity providers are able to back the markets without taking a position on price, or without being exposed to the position of the price of the assets. And because you have that long and short position balanced out, there's more opportunities to scale the protocol.
Right. So,
yeah.
I do remember though in the previous version of Synthetix, you had inverse assets as well, right? So you can have inverse Bitcoin. Right. So you could still go short, sort of, but you the combination of a CDP, especially you have a CDP on a volatile asset, against a debt position on a issued asset that also is volatile. So you got a vol position, and then, if I remember correctly, the entire CDP system essentially was in common. So if you had one position that massively outperformed, you could end up getting liquidated as a result of a position that you haven't actually created in the first place. That was sort of my recollection as well. So there was like quite a lot of complexity in understanding even what my risk was when I was providing collateral to the Synthetix system to create a derivative spot instrument.
I was just going to interject that is a big improvement in the V3 system over the V2 system, where with V2, there's just one debt pool, there's one set of issued synths, there's one set of collateral. And with V3, we have these separate liquidity pools that can back different subsets of markets. So one stablecoin can be used throughout this entire system. We get the benefits of scalability there. But you as a liquidity provider can just opt into the pools that are backing the markets that you select, so that you have a better sense of your the risk that you're assuming.
Right. So I can bucket my risk.
Exactly. You're not at the whims of every other market and traders' decisions.
Right. And so obviously, you guys are. I think perpetuals are a super interesting area of DeFi. It's an area that I have loved seeing grow. And perpetuals for centralized exchanges is one of their core businesses now. It's probably one of the biggest businesses for Binance. It's one of the biggest businesses for KuCoin, for Gate, for Bytebit. And I think that we're going to see a similar transition to what we saw when in DeFi summer 2020, when the decentralized exchanges, those core innovations of being able to create decentralized exchanges in the form that Uniswap introduced, meant that we now got a position where the decentralized exchanges are seeing more traded volume than some of the biggest spot markets in the world. I think we're going to see the same shift where decentralized exchanges have the opportunity to capture as much, if not more, of the volume from the centralized exchanges, which is sort of a multi-trillion-dollar industry already on crypto derivatives globally on an analyzed basis. However, I think there are a lot of challenges there, like with building spot, especially in the Uniswap model. I don't need to have anything other than very simple mathematics of the ratio of two assets plus an assumption of arbitrage. However, in perpetuals, because the price is actually coming from a reference, you have to have an oracle. And as a result of that, it's got to be fast. You've got to have great charting, because the kind of traders who trade perpetuals are the kind of traders that want to be looking at the 1 minute graph. So how are you solving all of those problems? Like, talk a little bit about bringing Synthetix V3 to market, and how you think about attracting users away from exchanges and onto the Synthetix protocol.
Yeah, it's another great question. So there's a lot of underlying challenges with exploring how to integrate oracles and use price feeds to create these to build the protocol. At the end of the day, I think it's serving just how do we create a user experience that does mimic, Coinbase or Binance or these other exchanges. But at the heart of it, we need to come up with a way where liquidity providers can't be gamed, right? Where users can't front run, and that's sort of the fundamental challenge of like figuring out how to do order execution with these oracles. And so the pattern that Synthetix V3 uses, and Perps V2 has a similar mechanism, is this asynchronous order settlement pattern. So basically, you show up, you provide your collateral. You'd say basically, let's look at the clock. I want to exchange this amount of assets into synthetic Bitcoin or whatever. At whatever exchange rate exists, like now, effectively, like the timestamp on the block where the order gets committed. Then what a keeper is able to do is they're able to go out to an Oracle network, get cryptographically signed price data, come back with that, bring it on chain, and price data for the time that the commitment was made. And then the keeper is able to settle the order for the user subsequently. So basically, the end user experience is just you submit a transaction and you wait for it to go through. But there's no way for the end user to like front run a price feed, because they're not sure. You're sort of looking back in time to figure out what the price was when you made the commitment, and at the time you're not sure exactly what price you're going to get. I mean, you understand that it's going to be fair because it's what the decentralized Oracle network has landed on for that timestamp. But it removes any optionality from the trader. They can't back out of the trade because the keeper is going to come in and settle it. They can't pick a different price because it's specific to the timestamp that they committed.
And I can't cancel the transaction once it's been submitted.
Correct. Yeah, because the problem would be you could make the commitment, and then if the price isn't going in the direction you want, you would just want to back out and cancel, right? And like that's fundamentally that harms the liquidity providers, because then traders are going to game the system effectively.
So how do you avoid the problem of being able to cancel? It's because the keeper's responsible for submitting the transaction on your behalf rather than you submitting the transaction. So you have no control.
Yep.
Right, got it.
Yeah. And this was actually an interesting point of like an engineering focus for us recently, where L2s have these gas Oracle contracts where you can query them and get a sense of the current cost of gas currently. And then we plug that into our Oracle manager system to convert that into a dollar amount. And so when you go to submit an order, we're able to effectively quote an amount that will incentivize a keeper to settle the order, even if gas prices are up because there's high congestion.
If there is congestion, like how long could my transaction sit as pending with a keeper? Could I ever get in a situation where I've submitted something, it's out of my control, it could be submitted at any point between now and who knows when, and a keeper could pick it up in an hour or 2 hours, and I have no way of canceling it?
So I mean, the way this would work is generally it goes in and the keeper settles it because the incentive is set properly. It's not a matter of waiting as much as it's just more expensive to get it settled because gas prices are up due to the congestion. Yeah. You could end up in a situation where the order just is like in this sort of cancel only mode because no one ever picked it up. Although usually you can just settle it yourself, basically. Like if a bot doesn't pick it up, if for some reason gas like goes really off the charts, but that's sort of a rare
you can settle it yourself,
scenario.
Are you talking about like everyday people could settle it themselves, or like there is the technical capability for someone to settle it themselves?
Well, it's permissionless. Like the trading UI could just surface a button to say, hey, a keeper didn't end up settling this for you. Just click the button and then you get the fee yourself.
Okay. But then you do have optionality in that case.
Well, you're still getting the price at the time of commitment.
Yes, exactly.
And so, yeah. This is a rare scenario, though. Yeah, it's like we're setting the fees correctly. It's not. Yeah.
Right. Got it.
Yeah.
Okay. And so, like from a user experience point of view, how similar does this feel from trading on, say, for example, Coinbase perpetuals? I'm just trying. Coinbase actually does perpetuals. Let's say Bytebit perpetuals versus Synthetix perpetuals. What would be the main differences you'd feel as a user between the user experiences?
Yeah, I mean, with Synthetix, you need to sign a transaction basically and pay gas using MetaMask or whatever Rabby or whatever wallet app you're using. That is intimidating to some lay users. I mean, just using blockchains and at all is a bit intimidating. But with account abstraction and paymasters and like some of the ecosystem projects in Synthetix are focused on these different user experience vectors where, you can technically create a user experience with gasless one-click transactions and have someone else cover that cost. You need some part of the UX where the user is signing the transaction. But I mean, that's good, right? We don't want to get rid of that part. But yeah. But as it stands now, it's really just signing a transaction for the order and then it goes through.
Okay. And in terms of how fast you sort of get those confirmations of trade, you say you guys are on Base. Was there a reason that you guys chose I mean, you're on several chains, but what was the sort of reasoning behind choosing Base for your most recent launch?
Yeah, so Synthetix was one of the early adopters of Optimism mainnet. Actually, when I first got involved with the project, that was a major focus, was how to just expand to a single L2. Now everything's like multi-chain, and like we can't all just move to one different L2 because then there'll just be congestion there, right? So Synthetix was early on working closely on just getting the protocol working on Optimism. And Base is an OP stack chain. And so it was just a natural progression to shift some focus to deploying there, where we know that the entire like underlying technical stack is going to be effectively the same code as Optimism mainnet. The protocol is like just requires an EVM compatible blockchain, but because we're really pushing the limits of what's possible with this stuff, some like small implementation details between L2s. There could be some concerns there that we don't need to worry about if we're deploying on Base effectively.
Interesting. Okay. And how's the experience been so far? Like, of Base versus Optimism, difference in community, difference in performance, difference in sort of ease of expanding your user base?
Yeah, I mean, I think there's a lot of excitement around Base right now, for a variety of reasons, but in general, the fact that there's so much focus going into getting users on chain from Coinbase. I think it's a really exciting opportunity to reach a effectively new audience of users that are willing to experiment and try this stuff.
Are you seeing that? Are you seeing that Coinbase is specifically pushing its user base to go and use Base directly and to go and use products like Synthetix on top of it?
I mean, the ramping experience to and from Base is great. Like, it's not, I have no notes. Yeah. I mean, at the end of the day, like, everyone's working through a centralized exchange to get on chain, right? So, either way, so the smaller you can make that gap, the better off you are. And given that Base is Coinbase's L2, that's about as tight as you're going to get, I think.
Yeah. And do you see that as... Do you see this as a Coinbase hedging strategy, or do you think see this as sort of part of Coinbase's core strategy? In terms of, do you think that Coinbase is seeing the writing on the wall and thinks that all trading is going to move to public ledger, and their main function is going to be that little gap between fiat money in your bank account and crypto to be able to go and use these applications? Or do you think that this is there's sort of a view where centralized exchanges is always going to be a big part of their business, and L2s were for them to sort of get some skin in the game on the decentralized finance play as well?
I don't want to speculate on Coinbase's intentions here, but I think they're doing a good job. I mean, at the end of the day, I like to imagine we're not here to speculate on the value of Pepe coin. It's to actually use blockchains in decentralized finance. So I think, the more energy that they and anyone else is putting into getting people to actually use blockchains, I think is good.
So what's next for Synthetix V3, and what's next for the Synthetix project?
Yeah, so there's a lot of exciting stuff happening right now. I mean, a lot of the energy is focused on rolling out on Base. We've put a lot of energy into our deployment tooling, so being able to just spin up on more and more chains and doing more cross-chain like synthesis and communication is like a big point of R&D. I like long term, I don't think like when your grandma is using DeFi, she's going to know what chain she's using, right? It's like you want all of the liquidity to be synthesized across all of these chains, and we need to come up with a way to make them all work together, right? So I think that's one interesting point. There's a lot of work around building stablecoins on perpetual futures markets instead of the other way around.
Right.
Where you can have like a wrapped basis trade effectively as a stable asset that's fundamentally decentralized. So there's some interesting work happening there.
I had always wondered how long it would take for the crypto space to get to that, in terms of like, if you're essentially able to, what would it be? You're selling a long and buying a short on an underlying asset that you hold, you're essentially creating a stable coin because you're selling all the upside, you're hedging all the downside, and you're holding the underlying, so you have no delivery risk. As long as the market is balanced, that's going to be an asset that sort of looks like this with a yield, hopefully, associated with it, depending on which way the market's going for it. So, yeah, the main problem that you always have with that is that during crisis events, liquidity dries up, and often you want stable coins to be most predictable during crisis events rather than least predictable during crisis events.
Yeah, I think that's right. I mean, with the wrapped basis trade thing, I always think of it in terms of like there's no free lunch. So like, where's the liquidity coming from? And this goes back to the perps market design, where if there is a funding rate for arbitrageurs to open positions on other markets to like balance it out to have a net neutral position that balances the on-chain market, then like that to me is the piece that is like what unlocks the scalability. So I think it's less like if there's big price action on ETH or whatever, like that conceptually, I don't think that puts this this model, this mechanism at risk. I mean, I'm sure there's consequences that we need to be accounted for, but it does seem to me that like conceptually it makes a lot of sense. I think the reason why it's taken time to develop it is that creating actually scalable decentralized perps on chain isn't easy, and we're working on it. I mean, it's starting to work, I mean, we're at a stage where you can actually have a scalable perps market to get sizable enough liquidity for this to make a viable stable coin. So it's exciting times. That's
really cool. So what's the current liquidity of Synthetix? What's the current TVL?
I don't have the numbers offhand. The perps V2 on Optimism and mainnet is currently synthesized, like the collateral on both applies to both networks. And then the base deployment right now is isolated and using USDC collateral. So those are two. Just to clarify that there's sort of separate numbers for V2 and V3 right now.
Yeah, according to DeFi Llama, you guys are sitting at just shy of $1 billion of TVL, but I can't see how it's breaking that down.
That sounds like it's in the right ballpark for V2, yeah. And the base rollout is still early days, so we still have like pretty low caps on that. But the volume has been pretty impressive in the last week.
And just sort of like in conclusion to this conversation, I think one of the interesting things you mentioned when we were talking about this before we started recording was this idea of the Synthetix platform being a liquidity protocol first. Could you just help everyone understand what you mean by that and why that's powerful? Why it's powerful to think about this as a liquidity protocol first and like everything else second?
Yeah, absolutely. So, I mean, a big part of the effort with V3 was taking all of the learnings from V2 and rewriting the code base where we have the right modularity and abstractions that were sort of born out of necessity in iterating on V2. And so with V3, you have the stablecoin issuance mechanism in the core protocol. And then there's this market manager interface that separates out the spot market and the perps markets and any other types of markets, right? So you can take decentralized collateral, issue a stablecoin against it, and then go out into these market implementations and then use that stablecoin, or maybe you've sold it to a trader who wants to use it. And then these markets are, if things are going according to if everything is working, big caveat, then these markets can collect fees which go back to the liquidity providers and pay down their debt. Now, the markets can also incur debt, and they can also add debt to the pools that liquidity providers are participating in. But the abstractly speaking, the goal with the design of Synthetix V3 is to allow a collateral, over collateralized stablecoin with that uses decentralized collateral, and then be able to have all of these different liquidity pools that are backing all of these different markets with isolated risk, and then that's the broader vision, instead of just making it be like another perps protocol.
Right. So you go, all right, we can take any form of collateral. Each form of that collateral, we have a different view on how risky, volatile that collateral is. And so we'll give you a rate at which you can borrow dollars against in which you can create stable coins against this, and a collateralization ratio. So, if it's ETH, it's maybe 2x. If it's, Piers coin, maybe it's 100x, just depending on what the underlying risk of the thing is. But then you have this singular asset, this stable coin, and then you have all of these different ways in which you can deploy that asset, and you could deploy it by LPing into a perpetuals market, the Synthetix perpetuals market. You could deploy it by going into creating a spot derivative instrument. You can deploy it in many, many ways, but your core idea is you have collateral, you have diversity of collateral that you then want to turn into a unity of account, which you then want to be able to deploy into a diversity of different derivative instruments, which I think kind of describes a lot of what happens in sort of investment banking, trading side of TradFi, when you have very large hedge funds and they're sort of managing a huge portfolio of diversified assets and positions, and then you have all of these ways in which you can sort of generate yield and take short-term loans against long-term collateral, or lend out to market, and all these kind of things. You're sort of bringing more of that complexity as transparent tools on Ledger.
Yeah, I think that's an interesting way of thinking about it, for sure. Yeah, it's like there's that one problem of getting from decentralized collateral to dollars, and then from dollars into other things, right? And so there are different types of and those other things aren't necessarily like synthetic Bitcoin. It could be spot synthetic Bitcoin or perpetuals, Bitcoin perps, right? Or insurance markets, or really anything else. I mean, I brought up earlier, like seeing more diversity of oracles, I think, will also open up all sorts of different things, like prediction markets, more elaborate like options, structured products, things like that. And yeah, I mean, the beauty of it is that it's all open source and on chain, and people can plug in and integrate and build bots and front ends and contribute. And it's exciting stuff.
So if people want to learn more about Synthetix and specific Synthetix V3, is the best place to start on your website?
I think that's a great place to go. I think the Discord is also exciting. You'll get all kinds on the Discord, and there's a lot to learn from the community members there.
Awesome. So the spelling is synthetix.io. This will be also in the show notes. I definitely recommend checking them out. As I say, Synthetix is one of the OGs of the crypto space, of the DeFi space. They've done a lot of innovation, a lot of trailblazing. Super exciting to see Synthetix V3. And Noah, thank you so much for coming on the show.
Thanks for having me.
Need more utility, then you better call on these guys. I'm going radical, I'm going Radix, I'm going radical, I'm going Radix. Hyperspeed DeFi, never on a decline. Building the future, I feel like a savage.